If you're looking to buy a house or a condo, this is the single most important question you should answer for yourself before you buy anything. So here he's asking a very important question. He's saying that he's living with his mom, which is a really great thing to do to save money. And he's wondering about if he's making $6,000 after taxes, when can he buy a house or a condo? How much does he have to save? So you should write this down because as a principle and a rule, your total house or condo cost, which includes HOA, homeowner association fees, mortgage, insurance, and all that cost should not be more than 20% of your after-tax income. By the way, I'm Dr. Nagy. I'm empowering you with better habits to success and prosperity while you're living your best life. So let's use his example. So he's taking home after taxes $6,000. So he's wondering how much can he afford for his primary residence as a total monthly expense. So if he's taking home after taxes $6,000, all you have to do is take 20% of that. That's going to be the maximum he can afford for his primary residence total cost. So 20% times 6,000, that's $1,200. So he can budget up to $1,200, and then he needs to include his homeowner association fees, his mortgage, his insurance, and all that. It's all the expenses relating to his primary residence. It's $1,200 is what he can afford at most. So don't forget, this is not just your mortgage, this is all the added cost that's going to be involved with your primary residence, because some area real estate taxes as well as homeowner insurance as well as HOA, homeowner association fees can be really, really high. So you need to make sure to add those back up so you don't end up in a situation where you're spending 50% of your monthly after-tax income just to live in a place, because then might as well just stay living with your parents or just rent. Now let's use this as a further example, and let's just say if you live in an area where you can't get a house or a condo for $1,200. So how long should you save, or what should you do? And you have several options. Number one, I think it's a great idea to live with your parents if you get along with them well and you save. This is a very common thing in Europe, and I don't know why Americans don't normalize this, but this is one of the best way to save money. Actually, there is a lady in TikTok whose name is Strawberry Milk Mob, and she has lived with her parents for a long time, and she built a really successful, pretty large business while living at her parents' house. And she has a really big business now and doing very, very well. So it's a great idea to save money and work on yourself while you live with your parents. Number two, you basically need to save until you can make a down payment large enough to keep your budget under that 20%. Like I told you, like in your example, your income was after taxes was $6,000, your budget is $1,200 a month for your primary residence. So you need to save until you can get your monthly mortgage for that condo or that house under that 20%, which in your case is $1,200. Number three, how can you keep your budget down? There are several things you can also do. So for example, you could buy a condo versus a house. Now condos usually sometimes, a lot of times it's less expensive to maintain too. So a lot of times real estate taxes are less, and but the downside of that, a lot of times they have HOA or homeowner association fees associated with that, but they take care of the yard and the green space, and you don't have to mow or things like that. You just basically own the condo. The other thing you can do is you can buy a house that's more of a fixer-upper, and you can continue to live with your parents, and then you fix up the house if you can get something a lot less expensive, or you can move further out in a more rural area or more undesirable area where you can get a real estate, a condo or a house for a lot less expensive, or you can get a fixer-upper. Now, number four, and actually I like this one of the best. I had several friends who in the 90s and the 2000s and even today, they bought houses that have plenty of bedrooms to get roommates. So for example, I had a friend named Kathy, and she always had three roommates. She always had three female roommates. She bought a house that was 4 bedrooms, and she was able to actually pay her entire mortgage just from having roommates. So she's basically rented out each room for different women from her church. So she had three roommates, and those three roommates completely covered her entire expenses with the house. And she actually did this for 20 years, and she had a 20-year mortgage. So she completely paid off her house with zero expenses on her own just by having roommates. And actually, I like that solution one of the best, because then you get company at your house. You do have to have the personality, but of course you get along with people, because you'll be living with a couple people, 2 or 3 people, while you're renting that out to them, and you're getting income to pay your mortgage. I actually like this solution one of the best, because you get all the benefits. You pay for your house basically for free, completely cover your mortgage by other people paying you as a landlord, but actually essentially become a landlord. The disadvantage with this, you need to buy a house that's big enough so you can rent out 1 to 2 to 3 rooms, depending how you do it. This lady happened to rent it out to 3 people, and she rented it out to graduate students who were very busy. They were gone all the time, and in a break they went home. So actually it worked out for her pretty well because she had roommates, but they were never home. So this is actually a great solution. But so these are some of your options when you're looking for real estate. But and I'm asking you to really pay attention to this, because I have so many coaching clients whose monthly primary residence expenses are up to 50% and more. Even high earners like doctors, they keep buying these really large houses that have really, really large expenses. And then what happens is they become what's called house poor. So if you follow these steps, then you definitely keep that 20% in mind, and make sure you're adding all the expenses with the residence, not just your mortgage, but your property taxes, which could be pretty significant in some areas, and also HOA fees if there are any, also any maintenance expenses you're going to have with that. Of course, a fixer-upper is going to be more expensive to maintain and upkeep than a house that's already put together and there's no maintenance with it. And so you have to consider all those different costs on top of your mortgage, because that can really, really add up. And also insurance. Don't forget about insurance, because in some area, like for example Florida, insurance prices have been really going up for basically condos as well as houses. So you want to make sure that you get a quote for insurance before you buy a house or a condo, because you could be looking at a pretty hefty bill just for insuring your condo or your house. So let me know if you have any questions. My link is in my bio. If you ever need help with personalized attention, this is what I do for clients. I help them figure out a budget so they can come up with the better habits to build prosperity and a better life while they're living up, an enjoyable way of living. So hopefully this helped, and let me know if you have any more questions.